though, because I think this is a broader theme than what we were just seeing over this last week. Robinhood specifically blocking users from being able to buy shares of GameStop and other companies. Just taking a step back, what does this do to the dynamics for these retail traders and the dynamics of the share price itself, just to kind of level set what this means? And does this have broader implications from a regulatory standpoint on what needs to be done to rein in the Robinhoods of the world?
So it isn't surprising at all on a couple of fronts. One is that Robinhood has done this before, where in extreme volatility they've shut down trading. So you have to know, already being on those types of platforms, that it can happen. It has happened. And so that's the problem for the little guy, is that you don't have an avenue in which to trade if they shut you off. Look, after that, some of the platforms would certainly halt trading. You might have bigger issues. The exchange could halt the trading, and then you have the government coming in with the SEC to do a deeper dive on all this. So all that can happen. And the big problem is if the stock closes and you can't trade it, and then it opens, it can gap down, and that just means that the price it opens at is far different from where it closed at. You can get caught holding the bag, and a lot of people haven't really experienced that. And the problem is, look, you want a whole bunch of free trades, that's great. That brings a lot of pluses to the market. But with that comes some negatives of getting free trades. It's probably not the only platform you want to trade on, because other firms have not closed trading on those stocks today.
Yeah, I mean, it can happen, but I guess the question is, should it happen, where platforms like Robinhood can make the decision to halt trading, where hedge funds, institutions are still allowed to buy and sell freely, but these retail investors who are using Robinhood or even other apps are prevented from buying shares. Do you think this is something that needs to change, or this is just the nature of how Wall Street works at this point?
Well, I think that, nothing is for free, right? So if you're getting free trades, there's other stuff going on there with how are they making money, right? Whether there's soft dollars and a whole bunch of other stuff that goes on. So I think that you have to know, as an individual investor, that if you're going onto a platform that's supposedly free, perhaps it's really not. And with that comes some other things. And maybe if this is your first foray into investing, look, I don't like that they shut down trading at all. I think it's terrible. But what it also tells you, you have to know that if you're on that platform, it's a possibility. It really just happened. So maybe as you graduate to higher levels, if they don't figure it out, you go to a different place. So the market will take care of it, meaning the market of where people can do their business, where they trade, whether they're using an advisor or not. But in the beginning, I think it's terrible that it happened, and it probably shouldn't happen, but it just tells you they can't handle what's going on. So why are you on that platform?
So does this mean that this is an opportunity for other fintech platforms to benefit, if kind of the advice is diversify the platforms, the technology that you use to trade as a retail investor? Don't put all your eggs in the Robinhood basket.
100%, and that's the point. The point is that because other firms didn't have that problem, look, the exchange didn't shut it down. That's a different story. Nobody can trade that. This was the individual firm decisions to do that. It tells you who you're dealing with. So you have a decision. Do I stay in that platform? Do I transfer my account somewhere else? There are a lot of other avenues in which you can do your investing. Now, perhaps that doesn't mean that there shouldn't be some kind of regulation with a short interest. I still can't believe, with the amount of oversubscription, that the individual investors recognized the problem here. Somebody was asleep at the wheel, and they took advantage of it. And okay, great. That's maybe should be fixed. But it doesn't change the fact that you still need a trading platform that you can rely on. And they either got to do what they've got to do. The other firms that didn't shut down trading, what are they doing differently than these firms? That's what you need to find out if you're going to stay there.
So Doug, just zooming out on the relationship between retail investors and institutional investors, even before this whole saga, we had seen retail investors kind of paving the way in some ways for what to focus on, what spaces to focus on, and leading institutional investors in some way, especially during the pandemic. Do you think, especially after this week, institutional investors will think about retail investors a little bit differently and use them as more of a guide to, I don't want to use the word trending, but use them as a guide to where the interest is, where the demand is, and incorporate them a little bit more in their decision making on their investments?
Yeah, I think very much so. I think that they're much more on the pulse of what's going on, and we all need to pay a lot more attention to those things. There's no doubt that they're influencing in a way that they hadn't before. And maybe it's all legal, maybe some of it's not. I don't know. That's for someone else to figure out. But at the point, whatever they're doing, we need to pay attention and recognize it and do some things. Look, there were some ETFs yesterday that had big positions in GameStop and other things that became huge percentages of the ETF. And so it was having a repercussion across other types of investments where people didn't even realize that the way they calculated, they were having a larger and larger part of it. And so, yes, it's having implications. I think that's a good thing. I think that, we shouldn't have all the power based on just the hedge funds. Look, that's a bunch of billionaire people that are investing a bunch of multimillionaires' investments because hedge funds are a speculative small percentage of multimillionaire portfolios. So, if the individual investor gets a little bit of power here and evens the playing field, then that's an opportunity. I think that's good.
Yeah, certainly an opportunity. Doug, just amongst my peers, I've seen such mixed reactions on this story. Some people saying, I have no idea what's going on. Other people saying, I don't have any idea what's going on, but I'm going to try to buy GameStop. Like all of these different reactions across the board. If you're a new investor, you've never dabbled in the stock market before, what's your number one piece of advice at this point? And just trying to digest what's happening and come up with your own strategy.
Here's what you've got to do. You've got to say that what is going on here is basically like going to Atlantic City or going to Las Vegas. You put down on a number and maybe you hit and maybe you lose all your money. If you treat it like that, as that kind of speculative dollars, I don't think there's anything wrong with it. The problem comes in that some people get wrapped up because it is in a way the biggest casino in the world. Now, we're talking about trading, we're talking about betting. When maybe you do some of that, but realistically, investing is not that. Investing is buying companies that that have earnings, that have good management, that are selling a lot of stuff to other people. It doesn't matter who the president is, they're going to keep doing what they do and growing. And if you buy those and hold those and they're good companies, you will make money, and maybe you're going to get dividends and the stock will grow. That's investing, and that's the majority of what we should be doing. What we're doing here, speculation and trading and playing, is not investing really, because fundamentally that's the disconnect. Now maybe they turn into those companies, but with this kind of rise, that was certainly not going to happen. And that's, I think, the way you have to look at it. You have to say, am I investing here or am I betting here? And would I be better off going, assuming you can go out and go do that now, to a casino and enjoying myself, or this? And I get it, but that's the way you need to treat it. So that old adage of the lotto, which was bet with your head and not over it, always comes to mind. It's not investing, and that's the way you need to separate, I think, and you'll do fine.
All right, Doug, thank you so much for your time and your insights today. That's Doug Flynn, certified financial planner and co-founder at Flynn Zito Capital Management.